Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC-TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we're looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the large street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you from the CNBC TV18 Motorola Oswal newsroom, and this actually is the newsroom. I'm Prashant. With me, as always, my colleague Sonia and Nigel. Guys, hi. Good morning.
Good morning and happy 25th. It's CNBC TV18's 25th year. So happy birthday to all of us.
Happy birthday, guys. And, I just want to say very quickly, it's been 25 years of trust and timeliness. And I think these are the two things which make the market tick. So thank you, viewers, for staying with us these 2.5 decades as we've taken you through the ups and downs of markets. And guys, what a way to kind of bring in these 25 years, right? With the kind of market we've had over the last, 10 days or so.
Absolutely. I just think, first of all, of course, I want to wish all our viewers a very, very happy 25th birthday, because without our viewers, we are no one, right? So it is because of our viewers. We have tried to, over the last 25 years, stay credible, stay loyal to our viewers, and more importantly, stay relevant, right, in today's day and age. And it's not just us. 3 of us are just the face of what you see. Absolutely. It's an entire machinery at work. All the producers, the directors, the technicians, the guest team, the research analysts working tirelessly day after day to put credible content in front of you. It's not easy, but it's a job that's got to be done, and the best in the business is doing it. So happy 25th to all of us, and more importantly, to the team that makes it work.
Well, you have said enough. Party time, guys. Party time. It's our birthday. Very, very excited today. And as you all said, we are here because of you all, and you all have made us. So thank you for staying loyal to us. And thanks, guys. Every morning we wake up to each other, right? It's great anchoring with both of you all as well, and the entire team that backs us up. And for me, this day is always special. It's my mom's birthday. It's my channel's birthday.
That's
So I'm
amazing.
extremely excited today.
It's double the market.
It's double celebration. Triple, yeah.
And I've been here for more than half the journey. So very, very special moment for all of us, for all our viewers, and we thank you.
Wish you a happy birthday, Nigel.
I've been doing it for the last 13 years, so happy birthday, Mom.
Happy birthday, Auntie. It is a big day for all of us. But you know what? I do want to also take this opportunity to thank everyone here, even our viewers, right? Because we learn from them every single day. And in today's day and age of the digital landscape, you get so much feedback from your viewers as well, and that's how we are sort of evolving across, media platforms.
It keeps us on our toes,
It
doesn't
does,
it?
it
Every
does.
single day, and it's instant. So actually, it's actually sort of a great day, and we'll continue to get you snippets of the journey over the last 25 years. You'll get to see a lot of the team as well. What Sonia was talking about, the back-end team, which puts this program and other programs through the course of the day together. So we'll do that. But we've got a market to track, so let's kick this off in terms of what you need to know. We're waking up to not so kind of global cues. Let's just start with where we left off yesterday. We've had an incredible run, and how incredible? 1,000 points worth over the last 6 days on the Nifty is what we had. And that's what I was saying. What a way to kind of bring in this these 25 years. So we closed on the Nifty decisively above the 20,850 level. Actually, the first close above the 20,850 level happened day before yesterday, but it was just about 5 or 6 points. Yesterday was much more decisive with about a 0.5% gain, which came through, once again. So, the FII positioning in the derivatives market, which something we've highlighted all the way since Monday when we began. And by the way, we came into this week with FII's net short, some 47, almost 50,000 contracts on the index futures. Yesterday, it was next to nothing. Today, FIIs actually are long, 23,000 contracts long on index futures. And the reason this is important to track is, as the market has done very well over the last 3 days, and actually, even going into these election results, so the total is about 6 days worth, a 1,000-point rally. The comfort or the cushion which comes from short positioning, that kind of is gone now. FIIs are long, 23,000 contracts, but it's nowhere near exuberant kind of levels. All right, let's rewind the clock back. Overnight cues, not very much to talk about. Nasdaq was down about 0.6%. The S&P lost a little bit. You got the 10-year, which lost about 5 basis points. And you have the dollar index, which is above 104. It's been, not really decisive one way or the other for the last 2 or 3 days. And the market here has kind of moved to its own tune, to its own beat. Oil prices had a significant move. They were down about 4%, but in terms of a driver for this 4% sell-off in oil, not really. It looks like general risk reduction, which played out and showed up in oil as a commodity as well. I said this yesterday morning, same time. Maybe things at the margin in the very near term are getting a little stretched. So the daily RSI, for example, which is the relative strength index, a simple way to look at sentiment, that's at about 84. So we are, technically speaking, a little overbought. If you look at hourly sort of indicators, technical indicators, it looks like momentum is starting to fade a little bit. You got hints of that yesterday. I mean, the market was not able to kind of, rip through like what we've had the previous couple of days now. So that is point number 2. But I would say this as well, there is no clear sign of a significant price reversal yet. You need to get that. And how will you know if you're getting these price reversals? You've got to look at levels. So on the way down, the Nifty has got near-term supports at 20,795 and then 20,545. These are basically the 20 and the 40 hourly moving averages. I think once you get a close below the 40 hour, which is about 25.45, then you will think about maybe a pullback which may last beyond a couple of days. Otherwise, right now, dips will be bought. Dips to 2,700, dips to 2,500 most definitely will be bought. Bank Nifty had a bit of a divergence. It closed in the negative yesterday, so that needs more watching. Before this rally started, the Nifty Bank was the weaker of the two indices. So here, supports for the index come in at 46,674 and then 45,875. Again, these are very near-term hourly averages that we're looking at. And on the upside, I would still say on the Nifty Bank, a move to 47,700 is pending. But will that happen before, in a breathless kind of fashion, the market we've had, or will it happen after a bit of a pause? I would say that after the rally that we've had, wait, you will get pullbacks. Maybe it'll just be a day's worth or 2 days worth. But the risk reward right now with the rally that you've had in the very near term, and especially if you're trading, perhaps has turned a bit more unfavorable. Sonia.
Absolutely. I mean, there's nothing to complain, right? In this market, some consolidation is always a good thing. And I think as we've been saying before, when it rains, it pours, and it's pouring good news for the market. The additional good news that we have this morning is crude, and I'd like to pull that up. I mean, I think 5th day running crude has been falling now. It's now below $75 a barrel. It's a big positive, and this is ahead of the RBI policy. So that's another thing that the bulls will latch on to, the fall that we've seen in crude prices. So that's a positive. But the US markets, they ended with mild cuts overnight. In fact, it's been the 3rd losing day for the US markets. So in that context, won't be surprised to see some sort of consolidation in the market in the next couple of days. Let's not forget the Nifty is up 4% in just 5 trading sessions. That's been the kind of rally that this market has seen over the last many days. And perhaps the Nifty could consolidate around the 21,000 mark. But what's important is that the bottom of this market has moved up. Now, the floor for this market has now moved up to around that 19,000 level, and that's an important thing to keep in mind. Domestic institutions bought about 1,400 crores in the cash markets. FIs continue to buy. In fact, FIs have bought almost 9,000 crores in the cash markets this month so far, and we're not even in the, the 10 days in the month, not over just yet. So big buying from FIIs. Now, tomorrow you have the RBI policy, and that's the next big trigger for the market. Maybe not in this policy, but the market is now bracing itself for possible rate cuts, both from the US Fed as well as from the RBI. The expectation is that it will happen in the first half of 2024. So that's going to be the next big trigger for the market. But for now, the Nifty could consolidate around that 21,000 mark. There is a pre-election rally that the street is looking at. So when this consolidation ends, that pre-election rally is something that could take place, perhaps take the market to 22,000 as well. Time will tell. And there's a lot of value that's still left in large cap stocks. So let's not forget Reliance, HDFC Bank, Infosys, HUL, ITC are all still 10-15% away from lifetime highs. So perhaps there's better opportunities in large caps compared to mid caps.
Well, that's right. Guys, what a rally we have seen, right?
Yeah.
7 straight sessions, you end higher. That's telling you the kind of rally that we've seen on the markets itself. And for me, there are 2 big triggers from here on. Yes, the retail participation is good, and all of us have been putting in money, via the SIP route as well. And that's very encouraging. But for the markets to move up from here, you require the hot money, the FI money, the institutional money needs to come in there. And also the Nifty Bank, that will have to perform from here on. Maybe both those 2 points, they're actually interrelated with each other because the FIs have to come in. Remember, the exposure in India, close to around 32-33% is towards, banks. So both those 2 could be interrelated. Now, the FIs, they're net long on the index. So that's going to be very, very important. And just take a look at the chart on your screen. They are net long for the first time since the 22nd of September. So that's the kind of short covering that we have seen. We have a swing factor out there of close to around 2 lakh contracts. From being a negative, 1.75 lakh contracts on the short side, now you're going with a net long position of more than 20,000 contracts. So big swing factor has already taken place. Bulk of that short covering has taken place. Now all eyes are on the institutional buying. 2 strikes were very active yesterday, 20,900 put as well as the 20,950 call. And just plugging in both those 2 numbers, you get your levels out there. So the near-term support level for the Nifty will be yesterday's low around 20,850 and plug in the options data. Since the 20,900 put was seeing some writing, plug in close to around 70 rupees on an average. Well, you'll get 20,830 odd. That should be the important number. The levels come up for you on the screen in just a bit. Resistance level, since the 20,950 call was very active and the premium ended close to, it was on an average at the start of the session close to around 90 rupees. Well, you get that resistance level of around 20,040 odd. The Nifty Bank, that holds the key. It's rallied in the last 10 days or so, but it's an underperformer year to date. So the year to date chart should come up for you. That's still up only around 10%. The Nifty is up close to around 15%. You want the Nifty Bank to do a catch up of sorts. If that happens, then the Nifty is well and truly on its way to higher levels. But that holds the key. Nifty Bank and the institutional numbers are very, very important because bulk of the short covering has already taken place.
A lot of people on Twitter, etc., have been asking this feedback that you're talking about, that what should we do? Should we book profits? And even, anecdotally, whether there's been such a sharp rally, right? Yeah. Truly historic. So what I've been saying is, if you can stay invested, just stay invested. Don't forget about it. You'll get pullbacks along the way, but there's no real reason to get out because the market has moved 5% very quickly. It is quick. It is very quick. Yeah. Of course, if you're trading, then it becomes slightly different. It becomes trickier, and then you've got to take sort of, the day-to-day into account.
Yeah, I think, currently, at current scenario, you're basically building your portfolio for the next 5 to 7 years odd. Because in the, in the next couple of months, anything can happen. In the next, 12 months or so, anything can happen. But when you're buying good quality stocks, for a longer duration, I think it's that phase where you want to participate on the upside. You want the kids to have a great future, so keep the money coming in.
And also the good part, I guess, is that large caps have not participated yet, right? So if you have this FOMO feeling that, oh, the market is at all-time highs, I haven't participated. But guess what? All the large caps have not participated either. So perhaps this is the time when you go out there and put your money to work.
Absolutely. Well, we'll continue to discuss this. We'll get you lots of views. So let me give you a quick teaser of what's coming up here, right? It's our birthday, and we have a very special lineup of guests for all of you through the course of the day. Biggest market voices will join us. James Sullivan of JP Morgan will be with us. Naren of ICICI Pru, Samir Arora of Helios, Sridhar Sivaraman, and Nilesh Shah are some of the faces that you will see here over the next 2 hours or so.
All right, that's not all. The Best of India Inc. is also on your channel today. Dinesh Khara of SBI, Rajesh Jajurikar of M&M, R. Shankar Raman of L&T, Shenu Agarwal of Ashok Leyland, Prabha Narsimhan of Colgate-Palmolive, Ramesh Swaminathan of Lupin, Viren Shetty of Narayan Health, and Atul Lal of Dixon Technologies.
At 10:30 today, market veteran Ramdev Agarwal will join us as our guest editor on the program, where he will discuss the rise, the fall, and the resurgence of Zomato. Zomato is Ramdev's big bet right now, so stay tuned to CNBC TV18 for an action-packed day.
All right, first up, there's so much happening in the next 2.5 hours, so keep it with CNBC TV18. But first up, let's start with the equity view coming in this morning. We have Amit Sachdeva of HSBC, who says that many positives are coming through, from solid earnings to falling US yields, which are driving the view that the bull market will extend into the first half of 2024. However, next year will be different, as the general election will make the market more volatile, and a fractured mandate is a key risk. Banks, healthcare and energy are the sectors that are favorably positioned. We also like autos, retailers, real estate and telecom. Sectors that are unfavorably positioned include FMCG, utilities as well as chemicals.
Well, some views on the rupee as well. This is Parul Mithil Sinha of Standard Chartered Bank, who says that the USD INR continued to trade in a narrow range during the week, despite good equity flows on positive sentiment post-state election results. Lower oil prices, weaker dollar. On the back of these, she expects the pair, the USD INR, to trade between 83.15 to 83.45 to the dollar next week, with markets closely watching US non-farm payrolls data and the MPC outcome here in India, both tomorrow.
Okay, and on the bonds, Parul says that the India rates remained in a very narrow range despite a sharp down move in global rates. She says global rates markets have priced in an aggressive rate cut from the FOMC in 2024, and she also talks about how domestic rate markets continue to be constrained by tight interbank liquidity and large supply of corporate papers. She also adds that the RBI MPC is expected to maintain a status quo on policy rates in the Friday MPC meeting, and the markets will look forward for any pointers on liquidity.
Well, let's run you through the top 10 list, and later on we'll get in further details on that. For the time being, we're just running through the list. We're looking at Network 18, we're looking at TV18, a couple of more stocks, BEL, SpiceJet. Their stocks will be reacting to positive news flow. While on the flip side, your Bharti Airtel, Paytm, IDFC First Bank, Ircon International, ONGC and Oil India, all of them will be reacting to negative news flow overnight.
All right, well, let's welcome in our first guest. James Sullivan is Managing Director, Asia Pacific Equity Research at JP Morgan. He's with us on the program. James, great to have you with us here. Appreciate your time on CNBC TV18. I just want to start with whether in the US there is a sense developing, and one is reading and hearing about it more and more, that bullishness is at a bit of a peak level. There are no bears left anymore. The institutional survey, which is widely followed, that was quoted as kind of pointing to euphoric kind of levels. Is that so, James? What's the house view in terms of markets in the US from here out?
Good morning. Thanks for having me on the program, and happy birthday to both the channels and relevant mothers. So hopefully everybody's having a good day. No, look, it's a great question, and I think you're very clearly seeing that in share price action. You're seeing markets go on a year-end rally in the US as well as in many markets here in Asia. The JPM House view is that that rally will continue through year-end. The difficulty that that presents from a 2024 perspective, though, is that you set expectations and the overall bar very high walking into next year. So we do see the potential for some market performance early in the year, very front half loaded. The challenge as we get into the second half is we do see an economic slowdown globally. We do see downside to earnings here in Asia for MSCI Asia Pacific. The street's looking at $51 in EPS estimates. The JP Morgan view is $48. And so not massive downside, but a negative earnings revision cycle. And you are likely to see changing expectations in terms of the potential for rate cuts. The market's priced in 100 basis points of rate cuts in the first half of 2024. JP Morgan House view is that's much, much more likely to be second half biased with the potential to push into the following year. So you exit this year very strong, very high bar going into 24. Again, some opportunities for strength, particularly off the back of idiosyncratic election timing in the first half of the year in many of our Asian markets, but then a significantly more difficult picture in the second half.
Okay. James, thank you for your wishes and happy to have you here on CNBC TV18 in a special moment. How are you feeling about a market like India? You know, we were just having this conversation about how if you would have stayed invested for the last many years through thick and thin, you would have created a lot of wealth for yourself. Do you think that continues to be the case in the Indian markets? And what is your advice to retail investors watching you right now?
So, look, overall, JP Morgan is overweight India looking forward into 24. The backdrop for that is a combination of growth, which we've talked about on prior programs, but also recognition that India is running the highest corporate ROE out of any country in Asia right now. And so you're not only seeing growth, but you're seeing extremely high quality and high return growth. And we do expect that that will continue. As you noted earlier in the program, the market index right now has largely been driven by mid and small caps. We do see opportunity in the large cap space, particularly in the financials and some of the consumer names. So we do see the potential for the market continue to roll from here. From a short-term perspective, looking at market positioning is extremely important. In our year ahead note, we had published the fact that foreign investors were underweight India. As you noted, that is already starting to mitigate, again, setting that high bar as we go into early next year. But from a full year 2024 perspective, we're looking at the Indian index, base case trading around 22,000, bull case trading around 25.
Hi, James, and thanks for your wishes, both personally as well as professionally. Well, what about China? You know, a couple of months ago, it would be logical to see some kind of money move there, some kind of interest coming into China. I'll tell you what, from there, India's widened the gap, and we have outperformed even more. Do you think Chinese markets at some point of time become attractive, or do you think investors would rather stay with earnings growth, with better, stability at the center? Your view?
So we think the China market is attractive right now. There's two ways of looking at it. From a broader macroeconomic perspective, you saw 1 trillion RMB in stimulus in October. The rumor is that we're likely to see another trillion coming out of the PBOC in the months to come. You are looking at an easing environment as we enter into the top of 2024 and the potential for a pickup in overall economic activity, which we're starting to see in a mixed way in some of the high-frequency data points. We think those will strengthen as we look forward into the top of next year. From a bottoms-up perspective, however, it's important to note that there are stocks and sectors that performed extremely well as we looked through 2023. And so one of the core discussions that we're having with investors regionally, but particularly relevant to China, is to some degree, let's ignore the index and let's recognize the fact that China pure EV stocks are up over 50% on a year-to-date basis. Elements of the China tech stack, despite the potential for geopolitical tensions, et cetera, are up over 60% on a year-to-date basis. So you've seen a massive dispersion in sector performance in China, which offers significant potential for investor returns if we're doing the bottoms-up work, if we're analyzing company and management level decisions in an era of very significant change.
So, James, the next big trigger for this market, both globally and locally, seems to be the impending rate cuts, right? The expectation is that it will happen in the second half of the calendar year 2024. Is that your base case as well, both for India as well as for the US? What are you penciling in?
So we are looking at the potential for rate cuts in the second half. The view from a JP Morgan perspective is that roughly a 60% chance of a recession as we look forward into the second half of 24, first half of 25. that would give the Fed significant and ample room to look at rate cuts. However, that would result in a downdraft to both global economic activity, which has a significant impact on us here in Asia. Asian markets in general are very linked to global exports, and as well as a downdraft in the potential for consumer spending. And I think the latter is a very important point to make. If you look at the upside surprise in consumption expenditure, particularly in the US, it's segued from excess savings that were built up during the course of the pandemic to really wealth effects on the increases in both real estate as well as the overall equity market in the US. If that starts to roll over, we would see a significant impact on consumption trends, beginning in the US and potentially in some Asian markets as well. So again, bottoms-up work, doing the analysis on sector specifics to understand the relative dispersion trades, both across markets as well as within markets, is absolutely critical as we look into second half of 24 in particular, because we are looking at very high levels of market volatility.
Okay, James Sullivan, as always, thank you for joining us, and especially on a day like today when we have big celebrations, thanks for being a part of our big party here on the Lal Street. Thanks for joining us. Okay, guys, we were talking about staying invested in this market, right? Just got some data. 25 years ago, the Nifty was at what level, 845.
Wow.
Yeah, so it's gone up 26 times, right, in 25 years. I mean, so it just goes to show that A, the power of compounding, B, patience, right, in this market is something that always works.
Oh, absolutely. If you have time on your side, it kind of papers over a lot of mistakes. I mean, even if you buy a little expensive, but if you hold on for a longer period of time, I mean, you tend to make money. James made a very interesting point. The strength of the equity market, I think we don't talk about it too much, but it's responsible for this, what we describe in classical terms as wealth effect, right?
Yeah.
People feel richer. And I think so much of the consumption, he was talking about the US and how that strength in US equities is driving real estate and high-end consumption. I think it's absolutely true here in India as well.
Absolutely.
A lot of the premium housing, I think I'm convinced, is, and we've asked real estate companies, I mean, of course, they don't have the data, but it's a cycle. It's a virtuous cycle right now, one feeding into the other. But I think it's worked so well over the last couple of years.
Prashant, just to plug in that point, if you're buying expensive as well, I had a chat with Monish Pabrai, and he said when Charlie Munger and all, they went ahead and they bought C-Scandy. They bought it at expensive valuations. It wasn't very, very cheap. They paid $25 million. And dividends from then on, in the last 30, 40 years, they've got $2.5 billion.
Wow.
Now, that's only in terms of dividends. Forget about the way the asset has moved. So you buy a little bit expensive, good quality, just sort of relate that as well.
For longer.
Those guys are in a different league. I remember there was an interview in which Buffett says, he says, we didn't hire investment bankers, we didn't hire, specialists to analyze C-Scandy when they bought it. You know what they did? They went and bought a box of chocolates and they had it. And I said, well, this
works.
The folksy charm of Buffett and Munger is legendary.
And that's what led them to Coke as well. The Coca-Cola investment 10 years later, that's what led them to that.
All bad habits working well for them, working really well for their portfolio. All right, let's slip into a quick break. On the other side of the break, our entire team will be with us to help you with the top 10 stocks that you need to watch out for today.
You continue to be the first port of call for actionable, credible, verifiable information for news.
CNBC-TV18, one goal, pursuit of excellence.
Over 2 decades of setting gold standards, over 2 decades of excellence.
All kinds of news starting from sports, politics, international affairs, cars, entertainment and whatnot.
Journalistic credibility at its finest.
One should watch CNBC TV18 because you know what, you'll hate to miss out on that money-making opportunity.
One reason to watch CNBC TV18 to stay ahead in the game.
Watch CNBC as we get to you the most unbiased and factual coverage of the ever-changing business landscape.
You need a reason to watch CNBC TV18. I mean, is there anyone else who's as good?
Watch CNBC TV18 because it is, and will always be the business leader.
Watch CNBC TV18 because the team and its work here just would not leave any alternative for you.
You know we're the market leaders, right?
Credibility and accuracy, no doubt about it.
Watch CNBC TV18 because we're in the business of creating wealth.
Best analysis in real time.
Well, we keep it classy. We're always with the news. We're the best in business.
And also because I'm on it.
Yes.
We're the best and we just keep getting better.
decoding financial jargon for the last 25 years.
Keep watching CNBC TV18 to stay ahead of breaking news in the world of business, ahead of when it actually happens.
Watch for news on the go. Here's to the heart and soul of news, to the stories told and the milestones achieved.
It's a road to financial success.
Please watch CNBC TV18 for responsible journalism.
Come on board with us and reach new heights.
If you have to trust financial news, then it has to be CNBC TV18.
Well, watch CNBC TV18 because we are the best in the business.
Keep watching CNBC TV18.
Stock market, huh?
CNBC TV18, embarking on a quarter century of excellence.
Well, if you've just joined in, we're here at CNBC TV18 celebrating our 25th birthday, 25 years of excellence in journalism, 25 years of bringing you the most credible news and, of course, staying relevant as well. So thank you to all our viewers once again for tuning in day after day. Our entire research team is joining in now to help us with the list of stocks you need to watch out for as we begin the day. First up on our radar is Bharti Airtel. So we have Rima joining in to give us more on that. Rima, over to you.
Hi, good morning. So Bloomberg has reported that Warburg Pincus is looking to sell $211 million worth of shares in Bharti Airtel via a block deal. Now, this amounts to roughly 1,750 crore rupees. Warburg is offering 17.5 million shares at a floor price of 1,005 rupees, which is at about a 1.9% discount to where the stock closed yesterday. And after the sale takes place, Warburg would have offloaded their entire stake. They would no longer be holding any shares of Bharti Airtel. But this is what Bloomberg has reported. CNBC TV18 has not independently verified the news. And as of now, we do not even have clarity on when the block is going to be taking place. Warburg has been periodically bringing down their stake. The last stake sale took place in June when they sold about 1.9 crore shares at a price of 868. Back to you.
All right. Thanks a lot for that, Rima. Well, Mangalam joins in as well to tell us about TV18 and Network 18, the merger details. Mangalam?
Well, the big consolidation was announced as far as TV18, E18 is concerned. Both of them will merge with Network 18. The merged entity will comprise of all the digital TV and news assets of the conglomerate. In fact, if you just want to apprise the viewers of the portfolio, TV18 has 20 news channels in 16 languages and CNBC-TV18.com. Network 18 has the News 18 platform across 13 languages and firstpost.com. And E18 is the one that owns and operates the Money Control app as well as the website. Even Viacom, which is a portfolio of 40 TV channels and Jio Cinema, will continue to be a direct subsidiary of Network 18. And Network 18 will continue to hold its investments in Book My Show. What is the merger ratio? At 100 Network 18 shares for 172 TV18 shares, the merger ratio from a listed entity standpoint is largely at par. E18 shares holders will get about 19 shares of Network 18 for every one share that they hold in E18 itself. From a consolidated numbers basis, this does not change much, largely because these companies, are included in the consolidated numbers of Network 18. But the company has said that integrated entity for news gathering and dissemination to result in cost and content synergies. So to that extent, we will see positive moves on the counters. Both of them were higher in yesterday's trading session as well. But all of this with the disclaimer that they are owners of the channel that you love and watch.
All right. Thanks very much, Mangalam, for that. Paytm perhaps could see some red today. Now, the smaller ticket loans which Paytm sort of gives out, it is going to have to dial it back. This, of course, comes after the RBI increasing risk weights on lending on the unsecured side. Abhishek is standing by with what the street is making of it. Abhishek, take it away.
Well, to begin with, Paytm in the presentation did mention that there is good demand seen in higher ticket size loan, that is loans between 3 to 7 lakh ticket size in the low risk personal as well as merchant loans. In consultation with lending partners like Aditya Birla Finance, etc., Aditya Birla Capital, etc., they will reduce less than 50,000 ticket size of loans and expand into higher ticket size loan. So merchant loans that they give out is to MSME segment and it is a secured loan. So it because it is a business loan and hence it does not get impacted from the RBI regulatory point of view. They'll continue to build on loan distribution business and they will expand their lending partner base. One large bank and two NBFCs in Q4 FY24 and in Q1 FY25. Now, Jefferies has written on Paytm they have a buy recommendation. Target price has been cut to 1,050 from 1,300 earlier. They said that the BNPL, buy now, pay later recalibration follows system tightening. So these disbursals, the BNPL disbursals form about 55% of overall disbursals and they will halve in next 3 to 4 months. So the impact on loan growth disbursals is for FY24 from 98% it comes down to 65%. For FY25 from 49% it comes down to 5%, and for FY26 it comes down from 43% to 27%. So the revenue cut estimate is between 3 to 10% for FY24 to FY26, and the impact on EBITDA adjusted for ESOP is at 14 to 16% over the next 3 years. So they also say that re-rating will take some time. Back to you.
Okay, thanks a lot, Abhishek, for that. We'll keep an eye out on Paytm. But let's hop across to Vivek. He has a bunch of stocks on his radar. Vivek, what are you looking at?
Well, quite a few stocks on the radar. Let's first start with IDFC First Bank. So sources tell us that Cloverdale Investment, that is a Warburg Pincus affiliate, would be pairing almost 1.3% out of the total 2.74% stake that they held in the company at the end of the September quarter. The deal size is close to $100 million and the floor price is at 85.7 rupees a share. Remember, even in September, they had pared down some stake. The other stock on our radar is IRCON. Now, the government is looking to sell up to 8% stake in the company, and the route that they've chosen is the OFS route. The base size of this particular stake sale is 4% of the total equity with an upsize option of another 4%. The floor price for this particular OFS is at 154 rupees a share. The stock has seen a stellar rally in 2023. The other stock on our radar, Bharat Electronics, the company has updated the exchanges about the orders that it has received. So total orders worth over 3,915 crore is what the company has received. And along with that, the company has also received an order worth 580 crore from the Indian Army. Now remember, this takes the total order book of the company in FY24, the total order inflow rather, to 18,298 crores. So the company has already managed to achieve 91% of the total order inflow guidance for FY24. So likely to exceed the order inflow guidance like the management told us earlier as well. And lastly, SpiceJet, the board meet, that's been held on December 11, 2023. Fundraise is going to be considered in this particular board meet via the preferential issue basis.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Manisha. She's joining to tell us about the overnight, slip that we saw in crude oil prices. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, yes, a 4% decline, and that has brought us down to 8% in this week itself in terms of crude oil prices. We're trading at a 5-month lows, and it's not just the crude oil prices. Natural gas is trading at a 13-week lows. Gasoline is at a 1-year lows as well. The strength in US dollar and the expectation that you could be looking at weakening demand going forward is weighing in case of the crude oil prices. The markets also are dealing with weak PMI data from Japan, US, and Eurozone in the month of November, and that has been weighing on as well. It also is about the Chinese demand, which has been uneven, and the Moody's outlook or negative on China has weighed onto the prices quite strongly. It is going to be about the U.S. non-farm payroll data tomorrow that the street will take cues from. But at this point in time, since we've broken below $70 already, the street does believe that 68 and 66 could be in sight soon.
All right, thanks a lot for that. Well, here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow today. There's TV18 Broadcast, Network 18, BEL and SpiceJet. While stocks with negative news flow this morning, there's Bharti Airtel, Paytm, IDFC First Bank, IRCON International, ONGC and Oil India.
All right, well, we'll come back with more on each of these names as we go on, but we'll take a quick break here. On the other side, Deepan Mehta, Director at Elixir Equities, will be joining in with what bets he'd like to make after the rally that we've had. That's coming up.
Happy birthday, CNBC-TV in India.
When you're CNBC-TV18 embarking on a quarter century of excellence.
Welcome back. Hope you're having a good morning. Well, for us, it's a great morning because it's our birthday. And to join in the celebrations, we have Dipan Mehta, Director at Alexa Equities, who joins us on the show. Hi, Dipan. Thanks so much for joining in. And thanks so much for being a support over the last many, many years to our channel, educating us, educating our viewers as well. Dipan, let's discuss a few stocks. Rima was telling us earlier there's going to be a large trade on Bharti Airtel. So that one could open up a little bit on the red, but it's been a strong stock. What's your view on that one?
Good morning, Nigel, and thank you for having me on your show. First of all, congratulations to you and entire CNBC team on Silver Jubilee. It's been a fantastic journey, and I'm really privileged to have been a part of it. Coming specifically to Bharti Airtel, I think the stock has done pretty well over the past few quarters or so. And the most important aspect is that gradually we are seeing positive cash flows because 5G investment is reducing. And the entire telecom space is clearly a duopoly. The only kind of fly in the ointment, so to speak, is the increase in ARPUs, and that's not as per what Street is expecting. But at some point of time, I think that should also start kicking in the form of higher usage or in the form of making adjustments to their plans, which can derive a higher yield. So very positive on the company, and I think next 2-3 years could see very good earnings flow because of higher operating leverage.
Okay, Dipan, hi, good morning, and thanks for joining us. And, I mean, it's as much your birthday as it is ours, right? I mean, you've been a part of this journey through thick and thin. But let me talk about some more stocks. We were all discussing how the large caps have just not performed this year, whether it's Reliance, HDFC Bank, Kotak Mahindra Bank. Do you think the time is now? And as a retail investor, is this a good time to be putting money to work in some of these large cap names I mentioned?
Good morning, Sonia. See, end of the day, these small mid-cap stocks do take their PE multiple guidance from the large cap stocks. So at some point of time, unless the large cap stocks don't start to move up and their PEs do not get re-rated higher, there's only so much that the small mid-cap stocks can also move up. So very positive on large cap stocks. It's only that the FI selling was keeping them pinned down for so many months or so. But now that that has turned positive, I'm very confident that large cap stocks will also do very well. Their valuations are reasonable, and they have underperformed. There's some amount of margin of safety also over there. And when markets are overheated or slightly overheated as they are just now, and you still want to put money to use, then it's better to go for safer investment in the large cap stocks rather than the small mid cap, where a bad quarter or a bad news flow can have a exaggerated effect on the negative side as well. So I'd be a bit cautious on mid cap stocks, small cap stocks because of the valuation. But if I had to put money to work, then large cap is where I would look at putting my money.
Dipan, when the RBI regulation on risk weights came through, I think that is still being understood, right? I mean, take Paytm for an example, as we were talking about it earlier, smaller ticket size loans. And I think we will continue to hear more and more about how banks and financials will moderate growth targets, etc., going forward. Any thoughts here on Paytm, if you want to add anything, or any of the other names there? Because financials as a space is seen to be, because it's not performed, is expected to do well.
Good morning. See, I think that the RBI move is phenomenal. Our lived through the IL&FS crisis and so many other banking crises. And I think the RBI is acting ahead and making sure that we don't have a crisis in the small lending, unsecured loan space. So although there is short-term pain, there could be long-term gain. And in fact, the kind of earnings growth which NBFCs and banks can generate could perhaps get extended. Maybe the NPA cycle also is further down in the future because of this RBI measure which they have taken. And they may take further measures as well if the kind of loans do not moderate as they want them to. And coming specific to Paytm, I think Paytm has got so many, revenue streams that if something is not working out for them, they'll start to focus on the other revenue streams. And they can always move higher on the ticket size. The main advantage of Paytm is the users that come on their platform and the ease with which they're able to do transactions over there, be it lending or be it insurance or even some of the other financial products. And from that point of view, I think that remains a compelling investment proposition. So I'm just waiting for the quarters in which Paytm starts to turn positive. Again, these are great businesses with very high operating leverage. So once the revenue starts to grow, most of it start to go to the bottom line once the kind of expenses also stabilize. So I don't think that it's something to be so concerned about, and it's very aggressive management. They will make adjustments as they go along.
Okay. We have many more questions for you. I do want your thoughts also on defense, right, which is a big space that has come back now despite the kind of rally that we've already seen. So more on that in a bit. We'll take a short commercial break. When we come back, we'll get you an excerpt from our exclusive conversation with S. Naren, the Executive Director and CIO of ICICI Prudential AMC. That comes up in just a bit.
At Taj, we would all really like to congratulate CNBC-TV18 on their 25th anniversary. And what a coincidence. We are celebrating 120 years of Taj. You're celebrating your 25th anniversary. We have a wonderful partnership. We wish you all the very best. Also for the coming festive season. Happy holidays, and wishing you the very, very best and a very strong partnership with our group going forward.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. We're about 5 minutes away from the pre-open session. It's a birthday, and we have a very special lineup of guests for you all through the course of the day. I caught up with S. Naren. He is the Chief Investment Officer at ICICI Prudential AMC, one of the largest fund houses. Naren, of course, is a steadfast value investor. He believes that Indian macros, the economy is in fantastic shape. The only squibble, according to him, is valuations. Listen in to a small portion of that conversation.
India is in a fantastic place, except that Indian valuations are completely different from the rest of the world.
Right.
If you look at it, that valuation expansion has continuously happened.
Right.
That's all. But
Right.
otherwise, if you look at it just from the point of view of outlook, I think there is nothing to say that there's any better country than India.
Right.
All the other countries have serious challenges in one form or the other, whereas India doesn't have those challenges.
Okay, so let's narrow it down. What's the big message? The consensus for some time has been, and you've been saying it as well, focus on large caps, don't focus on mid caps and small caps if you're putting fresh money to work.
Yes.
Is that the main message?
Yes, absolutely. And the other message is clearly that you can't predict the top of this market. Because the top of this market will be determined by how much foreign flows come in 2024. It can't be predicted by local flows because local flows have been very good over the last 2 years. They've taken markets to where they are without foreign flows. So markets can absorb a lot of foreign flows and the markets can go up to the extent that foreign flows come in 2024. Almost everyone we speak to say that foreign flows are yet to start. So if they come in a big way, you can have a much bigger move, and that will be obviously more large capish. But how much they will be is something which people can't predict because it depends on how the US economy shapes up, how US interest rate shapes up, and those kind of factors will play a role in determining how much foreign flows will come.
But again, to that point of mid caps and small caps, are you saying that if you put fresh money to work in mid caps and small caps, be prepared for below average returns over the next 3-4 years?
Yeah, there we have a simple framework. We call it the boom cycle. In a boom cycle, when people invest, you don't make big returns in the medium term. And that boom cycle has been clearly seen in mid caps, particularly in the last 6 months. And in that framework, we've always seen that if you invest in any boom cycle, whether it is IT in 2000, whether it is infra in 2007, whether it is small and mid cap in 2017, again now, you don't make money in the medium term. You will make money in the long term, but you won't make money in the medium.
So what is the thing to do for people who are watching for inflows into equity funds has been extremely strong. Inflow into equity markets have been very strong. New demat account openings have been through the roof. But where should investors put money, fresh money in?
So I think, at all-time high, all-time caution is required. And in the years of investing that I've seen, how do you practice more caution at the top? That's the toughest challenge.
But you're not calling this a top. We don't know if this is the top.
This is not the top.
Right.
All-time high is a period where you have to exercise more caution.
Right.
And the areas where people have to actually exercise more caution is not in mutual fund and hybrid. It is if you invest through derivatives, for example. If you invest in IPOs, for example, in sectors which you don't understand. These are the areas where people have to actually exercise more caution. And that is our learning from the past. And we always tell people, look at simple indicators like price to earnings, price to book, dividend yield, return on equity. If you're able to identify these things more clearly in a stock, you're in a safer company. Otherwise, you have to do much deeper work on that company to decide whether to invest or not to invest.
Well, time to slip into a short break. You come back, we'll get you market opening. We'll also get our technical experts who'll be back with us.
Powered by Century. CNBC TV18, embarking on a quarter century of excellence.
Okay, as we celebrate 25 years of excellence in journalism and business news, we welcome two guests on our show who I think have been with us through the course of this 25-year journey. Mitesh Thakkar and Sudarshan Sukhani are joining in. Sudarshan, I know for the fact, has been there since the very beginning. So, Sudarshan, it's a happy birthday to you as well, and to, of course, all your viewers, your followers, etc. It's been a great ride so far. And how are you feeling about it now? And what do you think the way forward could look like on the index?
Good morning and thanks, and a happy birthday to all of you and all the viewers. And I think CNBC brought about a revolution in financial broadcasting and information, and that persists and continues. Now, this is about the markets today. The Nifty is in an uptrend, an appropriate position for the CNBC birthday. It's likely to continue to be an uptrend, so the trade is very simple: buy every dip.
Okay, the trade is to buy every dip. Mitesh, happy birthday to you as well, and to all of your followers. Thank you for staying with us through the course of it all. Do you think the market now is getting into some sort of consolidation phase, or do you think the uptrend is pretty much intact?
Morning, Sonia. Birthday wishes to the entire CNBC team and the viewers. On the markets, I think that we are in a strong uptrend. Now, what has happened in that is that in the last 3-4 sessions, we have had a very strong rally. So, you have some overbought readings on the intraday charts. The hourly and the 2-hourly charts are now showing some kind of overheated situation. But if you look at the slightly longer term time frame, I think the markets are possibly heading towards 22,000. And since you're in a new high and you typically don't have any historical resistance, good chance that we might actually keep making higher highs till we get any signal of reversal. So very strong markets for me. I don't think we'll get a consolidation, but yes, what can happen is that because of the overbought situation on the intraday charts, you might get a day or two of pullback. So for me, that would be a wonderful buying opportunity. On the Nifty, the level is around 20,500. On the Bank Nifty, it's between 46,500 to about 46,400. I think if you get these levels, go aggressively long, you'll have to take a stop loss of about 1% or so on the indices. But I think this market will surely make higher highs in the coming few weeks.
Got it. Okay, all right. Good morning, gentlemen, and thanks for being with us today and over the last few years. Mitesh, you go first. Tell us some stock picks for the day.
Morning, Nigel. I have 3 buys to a sell today. HDFC Bank, we have had a recommendation last week as well. Last couple of sessions, it's been giving a pullback. So around 1620, 1625, a buy with a stop at 1604 and a target of 1660 can be looked at. A buy on IRCTC with a stop at 726 for targets of 770 and a buy on Wipro with a stop at 412 for targets of 430. One sell call, I think Cipla has had some kind of negative candlestick pattern and indicator set up yesterday. So that's a sell with a stop at 1221 for targets of 1165.
Sudarshan, what about you?
Well, it's all buying. I think this market deserves to be bought into whenever you can. Sun TV is a buy, and then I have ONGC where a buying opportunity exists. Finally, LIC Housing and Infosys. I'm not giving stops because the markets may be a little choppy. It's much easier to focus on positional trades rather than intraday. I'll just repeat it: Sun TV, ONGC, LIG Housing, and Infosys.
All right, gentlemen, great speaking with both of you here. Thanks very much for those trades that set up. Chandan Taparia is also now with us to tell us on a derivative and technical side that what to do is, of course, with Motilal Oswal Financial Services. Chandan, good morning. Good to have you here today. Quick thoughts, Chandan. How's the setup? You know, from a FII positioning in derivatives, they're now finally long, some 23,000 contracts. You know, is there still enough comfort out there to go long, or should one wait for dips to go long?
Good morning, Prasant, Sonia, and entire team, and wishing happiest birthday to CNBC. Looking at the market, we have seen a tremendous rally in the last couple of days. Nifty rallied by 1,000 points in no time. And if you look at the FI's long short ratio, that has recovered to 50%. Just a couple of weeks back, the ratio was below 10% or near to 10-12%. So recovery in the FI's long short ratio clearly indicates that they are big and DIs are already participating along with the retail. So buying support led by short covering from FIs are the reason that why the market is inching upwards. And we believe, and because of that, buy on decline could continue. However, not expecting major decline, but every small support could be utilized for the next leg of rally. So looking at the same, we are suggesting to buy Nifty with any small decline with support of 20,700 and looking for a fresh leg of rally to us 21,250 level. Today's weekly expiry and 21,000 call writing is there. So because of that, it is finding some sort of consolidation. But till it holds about 20,700, expecting this run up to continue to us 21,250 and beyond. Now looking at the Bank Nifty index, yesterday we witnessed some profit booking, but major trend is intact. Buy on decline could continue. One can buy with support of 46,300, and finally we are expecting a move to us 47,250 in the banking index. Tomorrow we have RBI policy outcome, so because of that some volatility could be there, but till it holds the key support, we will continue to be with buy on decline in the banking index as well. Now looking at the stock wise, recommending to buy on L&T. Most of the capital goods stocks are doing well, and L&T has the strongest structure. Lower beta with sustained buying interest and put writing activity is clearly visible in the counter. It is continuously making higher top, higher bottom, which indicates momentum to extend towards 35.20. One can buy with support of 33.40 level. Second trading idea, that is buy on IRCTC. Most of the CPSE or public sector stocks are doing well. IRCTC is one of the strongest counter given the breakout, and the way it has formed a bullish candle with built up of long position indicates momentum towards 777. One can buy with support of 727. Last trading idea, there is buy on BSOP. We have seen good momentum in most of the IT counter on last trading session, including TCS, Infosys, and BSOP is one of the strongest counter, making higher top, higher bottom on the weekly. Supports are gradually shifting higher, respecting to key moving averages. So recommending to buy with support of 643, and BSOP can head towards 680, 685 levels.
All right, thanks a lot for that. Let's move on now. There's a big development that has happened in the media space. TV18 and E18 will be merging with Network 18, consolidating its TV and digital news assets. Network 18 merged entity will comprise of all TV digital news assets, that will be put under one umbrella itself. To discuss more on this and the impact that it would have, Karan Taurani, Senior Vice President Research Analyst Media at Atara Capital, is with us. Karan, morning. How have you read into this event, and what does this mean for the listed stocks?
Hi, Sonia. First of all, wishing you all a very happy birthday to you and your team. In terms of potential impact, we believe that it really made sense to get all the businesses under one umbrella. What you are seeing right now is a very big disruption in the M&E industry, because all the mediums of advertising are moving very aggressively towards digital. And there are very limited levers over there, in terms of monetization. And what this will do is that, you'll be able to cross-sell, you'll be able to appeal to a larger set of advertisers, you'll be able to bundle this entire offering around entertainment, content, everything put together, and even maybe charge a subscription fee, to the customer. So I think this is a clearly very good thing in terms of a revenue scale potential. You could also see a formation of maybe a media super app wherein the customer is kind of persuaded to pay for multiple services. And even in terms of the cost, there is a benefit here, because you see merger synergies. You'll also see, cost benefits wherein a lot of the employee expenses, marketing expenses, the overlap will actually come down. So I think net, this should be a very good offering in a very fragmented digital market, wherein most of the traditional companies are finding it very tough to scale up.
All right. Hi, Karan. Good morning, and thanks so much for joining in. You want to quantify the benefits, Karan? If you could tell us rough envelope, back of the envelope, what kind of benefit could it be? And also, since we're going to be having both these two entities coming together, there'll be synergy benefits. Will it pose a bit of a challenge to some of the listed entities, or do you think the business perspective itself is very different?
So, Nigel, in terms of benefit, if you look at the number, as I say, across TV, print, and digital, the market size is about $18.5 billion today in India. And if you look at the TV and print segment over there, the growth rates are not more than about 3 to 4%. And if you look at the digital segment, the growth rate is 15% plus on a CAGR basis. And, if you look at the revenue scale of the entire company, it's not more than about $1 to $1.2 billion. And the market opportunity is about $18.5 billion. So I think, going to market together will lead to better growth rate, better market share across, these various categories which are there. So you could actually see superior growth rate, for this company as a whole. And also in terms of cost and benefit, what happens is that you've got multiple apps that you maintain. You've got some print app, news app, you've got some, business news app, you've got some kind of Geo Cinema app. So a lot of the costs, could be shared here, specifically the costs, which are very high in nature in the form of marketing costs, customer acquisition costs, employee costs. So that kind of benefit will also kind of give a fillip to the overall EBITDA margin of the merged co. And lastly, in terms of the potential impact for the broadcasters, we don't think that, this is a negative impact as such for Zee and Sun TV, because both those broadcasters are not based on news. They are more based on GEC kind of offering. So there's no impact on that for now. But this could have a potential impact on TV today, which is a news-based broadcaster. And they've also got a lot of digital assets on the print and the business side.
So what do you do with the stocks now? Just to summarize everything, what is your view on the listed entities?
So I think, in terms of valuations, if you see the valuations are not cheap. So, just broader numbers, I think on an EV/EBITDA multiple basis, they would already be trading at somewhere close to more than 20 times on a forward EV/EBITDA. If we assume a very strong growth and if you assume some kind of synergy benefits herein. So there is not much of an upside from current levels, but, potentially, one can look at this company from a digital company standpoint. And if you look at digital, that's the growth driver nowadays. 15 to 20% growth is, happening in that segment. So if one were to look at this as a digital first company, you would value it as an EV sales basis. And that's when you'll probably see some kind of delta emerging over the medium to long term. But that really depends in terms of, how they actually bring everything under one umbrella. How are they able to cross-sell, upsell? How are they able to target a large set of advertisers? How big can the entire opportunity become in terms of scale and advertising? And can they actually charge the customers a subscription fee? So a lot of monitorables are there, for the valuations to move up from here on.
All right, Karan, thanks a lot for joining in. And folks, we are here celebrating our 25th birthday on CNBC TV18, all ready to ring the bell. I have the entire team behind the scenes, all the guys who do all the hard work. So it's birthday celebrations for everyone here on CNBC TV18 and the most important person, our viewer, because of whom we are all here today. So thank you once again. I think we have, about 10 seconds left?
Yeah, let's go for the countdown.
20 seconds left before the markets open. And it has been such a rocking ride, right? Not just CNBC celebrating 25 years, but the equity cult really strong, all-time highs for the market. So a great day to celebrate.
Sridhar Shivaram is also with us.
Sridhar is right here with us.
Thanks very much for joining us.
Thank you.
Let's go.
Okay, 5, 4, 3, 2, 1. And there you have it. You want to go for it? Go for it, Arshan.
You guys not my take.
Go, sir.
Come on, Nigel. Go for it. Right, and there you have it, the opening bell.
Longer.
I think we can put some music to the commentary, right? Never gone.
Well, Manglam, it's the party, Manglam. Ring it.
It is the party.
Well, I think we've got markets which have opened, 60 points lower, 60 points lower. And things are looking, the opening wall will come up on your screen just to give you an indication. But as Sonia was saying, right in the morning at 8 o'clock, this is the team, if you can see it behind us, around us, which basically puts the entire show
Absolutely.
on it every single day.
And you know, we have Sridhar also here with us. Sridhar, thank you for joining us.
No,
great time to be in the market.
Of course.
All-time highs. How are you feeling about it?
No, actually, I want to take some perspective. That 25 years, I started in '93. There was no CNBC then, and we used to call up the ring to get the prizes. I mean, these were the dinosaur days. And from there, you know, when CNBC came, it was a big change for people like us because we used to get regular commentary, the ticker. I mean, there's been a huge change in how we've been investing, say, 30 years back to when it was post-CNBC. So a big thanks to CNBC for all the effort that you guys have done to bring about corporate governance changes in the market by asking difficult questions to companies. And I think it's a great credit to the entire team of CNBC for what you've done for the markets in general. That's how I would say.
Well, Sridhar, how are you feeling about the markets, though? You know, we are definitely in celebration mode because it's our birthday, and the markets, well, we're on our way to 21,000 odd. What do you think? Are we getting a little bit ahead of ourselves?
No, I think, I mean, once the election results were behind us, I mean, it's reasonably clear that now we get one more term. If you ask me, my confidence level of 300 plus for BJP now goes up from, say, earlier 60% to now maybe 80-85%. So basically, the market likes continuity in governance because of the reforms that this government has conducted. I think that helps a lot in terms of how the markets will move from here to May and beyond. So I think the party will continue from here on. So I think the market will climb all walls of worries. Only big worry is the US inflation and the rates. Otherwise, domestically, we are broadly set for a big rally from here on.
Just one more query. You know, I always say that I'm keeping my SIPs going, but I'll personally as well, I have to tell you that I've been adding some gold as well, you know, in the last 10 days or so. And you have been, you know, a strong advocate that gold will do well over a longer duration as well.
So I've always maintained that the Indian woman is the best fund manager. Beat her returns and show me. And I'm a fund manager myself. I was just looking at the number, 20-year returns, sensex and gold, both at 14.3, 14.4. I'm talking of 20-year returns for gold and for the sensex. They're exactly the same. 1-year returns, also the same, roughly 14, 15%. So I always say, Indian women, they're the best fund managers. Beat her returns and show me we do so much work for this 14% return. Watch CNBC, look at balance sheet, analyze, and the Indian lady just buys gold.
I love the watch CNBC.
Is there a bit of South Indian love for gold here as well? No, that's not.
No, I think all women love gold. I mean, this is
no, I'm talking about you.
No, I don't buy the physical gold. I buy the digital gold.
And these returns are rupee, gold and rupee terms.
So which is what I always say that it's actually also the currency which. So it's a hedge against the currency.
Yes.
So the currency depreciates about 4-5% a year, and this is the best hedge against the currency. Having said that, I think equity has also given the return, so it is not
just one question. A lot of people want to know what from here, because the market has done so much. It's been a big step up in the last, 6 or 7 days. Can this continue all the way into the general elections? Will we see a rally like what we saw late 2013 into the general elections in 2014?
I think it's exactly like 13-14, because 13 had taper tantrum, and then you had the election results. And there were a lot of other global worries, but the market continued to, climb all the wall of worries. I think we'll see the same this time again, because FIs are so underinvested in India that we will see a shift from other emerging markets to India, and we'll see this market rally through up to May and beyond, is my view.
10, 15%, 20, what
honestly,
numbers
I don't know.
Broadly, what kind of a rally? A meaningful rally, right?
History suggests more than 10%.
No, I would say that we should continue with the returns that we've given in the last 20 years, which is like if we can compound 14-15% over the next 5 years, you're talking of doubling from here in like 4 years then, roughly, So I think that's a great number. You're talking of almost 42,000 nifty. So by the end of the decade, we'll be close to say 55,000
on the nifty. Wow. Okay. So, there was one space that you were really bullish on, which is PSUs, right?
Yes.
It was. I remember having this discussion with you, I think a year and a half ago.
21 February.
Yes. Wow. And since then, the PSU banks have rallied substantially, and PSUs in general. Now they've come back once again. Under that umbrella, where do you still see value?
So I think, Sonia, every decade we see a regime. So if you go back to the previous decade, the regime was high growth, high PE stocks. And that extended to such an extent that It was just high P. The E disappeared at some point of time. I think the regime has again changed. Something happened post 21, and the market has gravitated towards value to some extent. And fortunately, these value stocks also have started to return earnings now. So if you see the last 3 years, the best performing sector is PSUs, which is giving you a 50% CAGR. And the PSU banks also 50% CAGR. And the next one is like 20% below if you look at any other sector. So obviously something has changed. And this is what I tell people, that when I look at some of the banks now, even after say 4 times, they've gone up 4 times, they're trading at 5p, 6p. You can still argue that, you know, it can double from here, and still you can justify the value. I mean, I was just reading a report on the ONCs. I mean, if the numbers are right, they're trading at 5p, 6p. Right. So I'm not suggesting that you should buy or sell. I'm just saying that we are at an early stage of this because the starting point was so low that even after this spectacular rally, you can easily justify that if I give, you know, 10, 15, 20p for other sectors.
You can give maybe double-digit
you can
Ps.
give double digits. I'm not suggesting that you go and buy any of these.
No.
I mean, every individual takes his own call. We remain bullish on this segment. We think that the regime has changed. One last point, if you look at the top 10 Nifty for this year, there are 5 PSUs in there.
Yes.
And there are 3 auto stocks in there, which you know very well.
But my question was more towards, see, PSUs is a big basket. There are defense PSUs, there are power PSUs, there are banking PSUs. Where do you pick? Where do you pick from?
So Sonia, that is the skill of the fund manager.
Let me just
right?
add to that. Is there I think there is a PSC Nifty. The PSCB's product, right?
Yeah.
So instead of choosing, for viewers who are watching, does it make sense
fund.
to buy a
In fact,
basket?
You go back to the 21 interview I gave, I had suggested that there are 2 PSU mutual funds.
Yes.
So for a retail investor, in my view, that is the best option. There's a SBI mutual fund and there is an Invesco PSU mutual fund. In fact, I was looking at it yesterday. The AUM is only 800 crores.
Wow.
I'm like, after 50% CAGR return, even now people are so skeptical. So that exactly tells me that nobody believes in the story. And I was actually so happy. There's a fund manager who comes on your show, I don't want to name, who is from Singapore, who comes regularly on your show. He recently added 3 PSUs in his portfolio. And for someone who's always said, I'll never buy PSUs, I was happy to see that there's a change. A slow one, but there's a change. I think there's a lot of denial. And I think a lot has changed in the PSUs. I think the governance has changed, the business model has changed. The stress from the government that you have to be profitable has changed, barring a few segments where they have their own issues. But I think this is a basket. I think the entire value basket is worth watching. So I think when regime changes, it is not like others will not perform. The other segments will also perform, but there will be a leader. If you ask me, possibly the leader is PSUs. I could be totally wrong, okay? But looking at the early, indications, when a regime changes, it changes for at least 10 years.
I think that's very useful advice. The mutual fund route, buy a basket instead of trying to pick this or that.
Even what you suggested is also an option. But I'm just saying that it's better to buy a basket rather than betting on individual stock, because that is a skill that we have. May not be possible for an individual investor to pick and choose, because as you said, some of them are trading at 2p, some of them are trading at 50p also in the PSU basket. So it is not a homogeneous set anymore because they have rallied 50% CAGR. I mean, that's a massive number.
So SBI and Invesco are the 2 mutual funds you spoke about.
The 2 mutual funds who have, and the AUMs are so low. I mean, I'm shocked. I don't even think they are marketing. I mean, it can't be that after 50% CAGR you have only...
I mean, actually, even when you buy funds nowadays, the challenge is funds are now 30,000 crores, 35,000 crores to find something where AUM is 800 crores. I mean, that's a rarity.
I invested in a children's mutual fund and I thought the AUM is only 1,000 crores. So this has the potential in the next 10 years is going to be big returns. I missed out on this PSU mutual fund, so I'll go ahead.
You didn't see the show I did in 21.
I'm going to do that. But we have gone on enough about the PSUs. Sridhar, I want to ask you about the backbone of the market, which is the banking names. And the larger banks, they have been big underperformers.
Yes.
Do you think the time has come, if you're looking at the banking space, yes, put some money in PSU banks, but some of these large private sector banks that have actually underperformed, is it time for them to come, take strike and maybe perform in line?
100%. So we are very bullish on the private banking space. See, they've had some challenges because of how the interest rates have moved. Deposit costs have continued to go up. look at RBI's commentary, they have been tightening liquidity. So I think some of the headwinds for the banks are there. But I think some of these private banks have managed these risks many years now. I think they are very well positioned to, move from here. Their profitability will also move from here significantly because credit cost is not going up, even though there are some risks like RBI has been, flagging the risk, and rightly so, which is on the unsecured personal loans. We remain quite bullish. We think that the underperformance that they've had was for the right reason. But from here on, this looks like a segment. And the other thing is when FIIs do come back, we are seeing early signs of that. This becomes an easy segment to enter. So I'm quite bullish on that segment.
I'm having a conversation with another fund manager. They said, Nigel, since you like cricket so much, it appears these private sector banks, they got their eye in, now they're seeing the ball and now they're going to perform from here on because they've got their eye in, after a long time of underperformance.
I would agree with you. So there are different baskets, different ways of reaching your goal, right? If your goal is to get 15%, there are different ways you can buy PSUs, you can buy private sector. I'm not suggesting that the other components in the market will not do well. And when there's a bull market, all components do well. As they say, rising tides, it takes up all the boat. But there'll be some leader, and possibly that's how I'm positioning myself.
Okay, Sridhar, since we're celebrating 25 years, before we wrap up, if you had to give one piece of advice to your 25-year-old self, what would it be?
Which is to have invested early, do a SIP. We didn't have SIP at that time. If I tell my daughter, who's like 22, my son, who's 26, that invest every month from your salary, because the earlier you start, the corpus that you build by the time you are, say, 30, 40 is so huge. And the power of compounding, we just don't realize that it is so huge that if you are going to compound your money at 15% for 10 years, that's a massive number that it becomes the corpus that you build at the end of, say, 10 years. And that corpus then compounds at another 14% if you stay invested in the market. And I have no reason to believe that what we've done in the past 20 years, we should actually do even better, because I think maybe the next 10, 15 years will be the great years, because as we move from 2,500 per capita to, say, $5,000, typically markets give disproportionate returns. You look at what happened to China, or see Korea or Taiwan, and see what happened to their markets when their per capita moved from $2,500 to $5,000. They all gave outsized returns. So I would want to bet that we will follow the same path. We'll give outsized returns. And so this is the time to stay invested and not worry about the timing of the market.
Time in the market, not timing in the market.
Yes.
Well put, Sridhar. Stay with us. You were talking about a fund manager from Singapore, right?
I'm not
we actually have a fund manager from Singapore.
Who joins us very frequently, by the way.
I'm not going to comment on
Samir
that.
Arora is with us. He's, of course, the main man at Helios. Samir, great to have you with us here on this momentous date. We're celebrating 25 years CNBC. And sorry, we can't hear you. Go on.
I was very happy to see Sridhar saying that if the markets are up, everything is up, including PSUs.
No, are you the fund manager from Singapore? So, if you heard Sridhar earlier.
I am not the mutual fund manager, but broadly we also have many of those same stocks. But the point is that we have our fund, and me personally, we are the flexible fund managers. So at various points when it didn't justify, it was not in the portfolio, these PSU stocks, some of them still are. But anyway, I still don't agree with this painting the brush that something has changed. If Sridhar can explain to me the difference between, say, I don't even know whether it's listed or not, Bank of Maharashtra and Central Bank, and which one has anything other than price to book is 0.4 and 0.42. I would be very surprised that anybody knows that. So beyond a point, we cannot buy stocks based on some price to book arguments, because in many of them, we don't even know why they exist. What is the difference between one and the other? What app they have, what millennium crowd they have, what is it other than price to book? So it is up to a point is right that in some sectors, the PSU leaders are leading, but it is not that buy PSU baskets and buy everything. I will not agree with that. But
all right. Let me just, Sridhar can't hear you, but Samir can hear Sridhar. So let's just continue this conversation for a bit longer.
Sure.
Samir was essentially saying, sorry, say that again, Samir.
First, I have to wish you a happy birthday.
Please do that. Please do that properly.
happy birthday and best wishes. I've been there from day one, I think, or maybe even before you guys were formally called CNBC TV18.
No.
So I've been there all along.
Thank you so much, and thank you so much for being sort of there every time we call you, for your expertise, for your views, and I think you've been a strong guidepost for us in our markets coverage over the last 2.5 decades or so. Just to kind of complete that loop on PSU Bank, Samir is saying he's not impressed with the PSU rally.
So listen, I have great respect for Samir.
One minute. He go on. Samir, say that. I'll convey it.
I didn't say that. I am saying the basket, if you at one point say that since this is a rising market, everything is going up, that also includes PSU stocks. I was saying that between the 5th and the 6th PSU bank, what is the difference other than saying that their price to book is point something? What is the management? What is the strategy? What is the app? What is the technology? Nobody knows. For the top 1 or 2, which we have had forever, like State Bank, we've had since 2020, June or something. I know what it does. I know what its technologies. I know what its strengths are. I'm saying between the tail. In the tail, we don't know what it means, and we can't buy it off a price to book kind of number.
Okay, got it. Samir, first of all, thank you for your wishes, and thank you for being here through thick and thin with CNBC TV18. I mean, it's been a pleasure watching you, listening to you, learning from you. But, you know, I mean, we were just having this discussion with Sridhar as well as to what would that advice be you would give your 25-year-old self. And he said, you know, I would tell my 25-year-old self to start investing earlier. But now we've reached a phase where this new generation, right, we have the largest Gen Z population in the world. This new generation is very savvy about investing. So they know a lot more than the previous generation did. So what would your advice to them be?
I totally disagree with that. I think they know much less than we used to know because they don't read books. They only do options. They only do futures. And every day, because I am, you know, active on Twitter, even in terms of reading Twitter, not just writing on Twitter, every day one fellow will say, I bought this stock because this thing happened. That guy bought because I saw insider buying. So on one factor they are buying. And those factors are working right now because there is a bull run going on for the last 2-3 years in all these stocks, which you can buy with one factor. I bought this stock because yesterday the management bought. I bought this stock yesterday because it disclosed something higher than you see on Twitter. Every day, the total logic of the buying is one line, at least the way they present it. And so I think that they are taking it too casually. Yesterday, I heard somebody writing that his client said that he'll be happy with only 50% returns per annum. And things like that. So according to me, they should read books much more than we did, although we also read, and Sridhar and all, we were all, readers and are readers. There are many things I think they know less, but they shall learn over time. There is no free lunch in this business. Either you spend time or you spend effort. You can't just do 2-line research and buy things.
All right. Hi, Samir. Good morning. Nigel on this side, and thanks so much for joining. And Samir, the last time we spoke, you were saying that in case there's an adverse outcome on the 2024 elections, well, the markets could see a fair bit of selling, or could see some bit of downside. That it appears now that kind of uncertainty has been brushed aside, at least for now, going by the state elections. Are you feeling much better from here on? With regard to
No. I was feeling better then also because I answered the question that you asked. You did not ask me the probability of that event. You said if it happens. The thing in our business is that if we say that 2 things can happen, it does not mean that the probability is 50-50.
So you were anyways factoring in
5-10% theoretical probability that if something goes wrong, you will lose. You can't say no, market would have discounted it in 1 minute. That's what I'm saying. But I was always confident. We are running with 75-78% net well before this outcome, because you know that the probability of the event is less, but in case it happens, it is bad for the market.
Okay.
So this is not changing that, but obviously you can say that it is easier now to tell particularly foreign investors sitting on the sideline that, hey, don't waste your time ticking the last box that whether there is political certainty or not. It is sort of already there. And if you want to wait here, see this one, you've lost another, say, 3%, 4%, whatever. So it helps in that, and therefore it sort of feeds on itself.
Samir, you speak with a lot of foreign fund managers. Are they going to come in full force in 2024? Because, where the markets have reached now, locals have done it without very much help from FIIs. Now, of course, we got to wait for the foreigners. What's your sense?
So I don't speak to foreign fund managers. I speak to foreign allocator. You can say that there is a fund or somebody or the other. 100% they will come. 100%. But the thing is, it is not surprising because they have always come, except in a few bad years, 4 bad years particularly. Last being 22, and then before that 18, and before that 11, and before that 8. But other periods, every year, FIIs have bought because they also have growth in their AUM because of worldwide growth, some allocation from this sovereign, this, that, whatever. Now the question is whether it will be in full force. The reason for it being in full force might be because of their losing a lot of money and confidence in China. So if that reallocation happens, then the force becomes a real big force. Otherwise, anyway, they should be not net buyers, even in normal situations.
So
Now the difference is, there's a domestic buyer against it. So if both buy, then is where the fun starts, which is sort of we are all playing for.
Yeah, the good part, Sameer, is that large caps have not outperformed the market, right? Have not done anything actually this year. Most of them, Reliance, HDFC, Kotak, etc. Do you think that 2024 is a year when large caps will start to perform in a big way?
So we are betting that large cap financials will definitely perform in a big way because financials are otherwise doing well. And their stocks have not gone up and they are a large part of the market. So even if the foreign investor wants to be underweight, overweight, if he's starting off a 30% weight, he could be 25 or he could be 20 or 35, but he still has to put in substantial absolute amount of dollars into these stocks. For the other two groups, which according to me are IT, Reliance is one, but if I talk otherwise, it's IT, consumer and financial, which are the 3 large groups or large companies. IT sector, according to me, is still doing quite badly. And therefore, I don't think they will get the same amount of interest from foreign investors as financials. And consumer always looks a bit more expensive to anybody who comes in. Who's coming in fresh now would think that, was he waiting for this long to buy something at 40 and 50p and all that? So therefore, they could buy Reliance or they could buy the financials, is my guess.
All right, Sameer, so, in the next, say, 12, 18 months, do you expect HDFC Bank to outperform from here? It's been underperforming. You have, on the valuation parameter, if the FI flows come back, and if you like financials, that's the one that normally everyone would go to. So do you believe that the next 12 months will be much better?
That is absolutely right. And according to me, it is putting a cap on other stocks also. So when HDFC Bank does well, then only the other stocks will. Because even today, you can't have many bank stocks trading at premium to HDFC Bank so easily because of the long history of the bank. And it doing well. That is our bet. It is our #1 holding in every fund that we have.
All right. Well, Sameer and Sridhar, thank you so much for joining us.
You guys.
Thank you for being a part of our celebrations today. And all the best. This is promising to be a very good year. Not just 2023, but 2024 to come, right? With the elections, so many big triggers. So thank you both for joining in. Well, let's do one thing. Let's take a quick commercial break. On the other side of the break, it's CNBC TV18's 25th birthday this week. Entire week, we have been speaking to a whole host of top management. So in a bit, when we come back, we will have the management of Mahindra & Mahindra, a stock that has generated huge wealth for its shareholders. Rajesh Jajurikar, the head of Mahindra & Mahindra, will be joining in to tell us how business is shaping up so far. Stay with us.
Congratulations to CNBC, and you guys are the gold standard when it comes to business reporting. So I'm glad to be here and wish you guys another very successful 25 years from here on.
Co-presented CNBC TV18, embarking on a quarter century of excellence.
Okay, welcome back. You got the market, which is down 50 points right now. Just taking stock away, we are at about 20,888. And maybe just a run through of some of the big movers that we've had so far. Top of the list, and I'm going to start with gainers. The Adani Group stocks are still flying high. Adani Energy Solutions, which is the erstwhile Adani Transmission, that is up 5%. Adani Green is up 7%. Adani Total is up 10%. That part does very, very well once again. Tata Power is doing well. Power as a theme actually has done very well, 3.5% on Tata Power. Patanjali is up about 3%. There was an analyst day, I think yesterday. Sterling and Wilson Solar has been moving up 5%. Circuit is up another 3.5%. KEI Industries is up about 4% or so. There is GIC RE, which is up another 5.5%. Inox Green is up 3% and so on and so forth. And just to run through the big losers, my God, look at Paytm. That's a 15% cut coming through on Paytm. We were highlighting earlier this morning with Abhishek, some of the downgrades, etc., which have come through. And this is the risk on the day when that RBI increased risk weights. People like Jairam Sridharan of Piramal had highlighted smaller ticket size loans basically will be the ones which will be hit the most. And, fintechs, etc., for everything that they do, the bulk of the money is made on lending. And with this coming under a bit of pressure, I think the market is reassessing prospects here. Lever is down 2%. Maybe just take a quick look at that. IDFC First Bank is down about 3%. Ircon, Balrampur Chini, I think lost about 7% yesterday. It's up another 7%, is down another 7% right now. Stocks at about 403. AB Capital is down about 6% as well. So there are some pretty large moves, both on the upside and downside as well, as we begin this Wednesday's trading session. The Nifty with about a 50-odd point cut. It's a small cut, small pullback after the 1,000-point move that we've had over the last 6 days. Sonia.
Absolutely. So let's welcome our first corporate guest on board, Rajesh Jejurikar, who is the Executive Director and CEO of the Auto and Farm sector at Mahindra & Mahindra, joins in now. Rajesh, thank you as always for joining in, especially on a day like today where we celebrate 25 years of business news excellence at CNBC TV18, and you've been a large stakeholder of that journey. So thank you for being with us. And it's been, of course, so many years of excellence at M&M as well. As I spoke about earlier, so many years of wealth creation. How are you feeling about the couple of years to come, and what's the big vision at your end?
Sonia, Prashant, Nigel, firstly, congratulations to all of you CNBC TV18 teams for what you've accomplished. And the 25th anniversary is, of course, something very special. So it's, real privilege to be with all of you here today on this very, very important milestone that you've accomplished. And I was just wondering what you're going to be doing differently on our 25th anniversary. One is, you get all of us to chat with you. But is there anything you're doing differently?
Well,
sorry, I'm flipping this back on you.
For one thing, we went and we rang the bell, in our newsroom. We had an entire newsroom here with us. So that's something we did differently. But, I'm glad you brought this point out. Cool. Because in order to stay relevant, right, over decades, especially in this digital era, you need to do a lot of things differently. And I know that M&M is doing a lot of things differently as well, especially with all of your new launches. But you tell us, what's the best way to do this?
Well, like you said, it's we all have to be very excellence-driven in everything that you do, and that's really the way you positioned your 25 years, and that's the way we position our business, because we believe success is going to come out of doing things really well, raising the bar at every stage, and that's what we're trying to do with our new products, and products and experiences is really what drives value creation. So we are focused on our part of the role, which is bringing exciting products. We brought some really good products on the tractor side. Oja more recently under the Mahindra brand, very tech loaded. We've got Swaraj Target, which is a lightweight tractor, the whole new Swaraj range with the Dhoni, with Mahendra Singh Dhoni as the brand ambassador. And of course, some very exciting SUVs. Our pickups have been doing very well, and last mile mobility electric. So, it's been an exciting time. And really, like you said, celebration should be around excellence.
Okay. Since you're talking about numbers, right, let's get it to the brass tacks numbers. This month in November, the wholesale sales were up 20%. And that's not a small achievement. 20% month over month for the last many months is something that is perhaps hard to sustain, especially in this competitive environment. I just want to understand that, is it going to continue continuously be led by the growth in SUVs? Because you are putting some capex on board as well. Your SUV production will go up. What is the kind of numbers that you're looking to achieve over the next couple of months?
Can't give you specific numbers, but just to break up the numbers that you spoke about, the SUVs grew 32% in November. So, we did a volume of close to 40,000 and that was a 32% growth. Pickups, which is on a very large base and, in the less than 3.5 ton light commercial vehicle category, we have a very strong market share. We are, in the range of 48, 49%. So very strong market share. We've gained 4 or 5 share points. There we grew 13%. So that's very credible on a strong, on a already high base. So overall, I think these are very good numbers. To your specific point on how will we sustain momentum, in this business it is about especially in the auto side about new products. So we would have some new products on the ICE and then the whole electric portfolio which will come in early 2025. So we believe that will help open up a new category of customers, people who are looking for exciting design, technology and a whole totally new driving experience which comes out of the very quiet electric powertrains and very peppy, very powerful, very fast. So we believe that's what will drive future and that connects to your point on driving excellence.
Rajesh, hi, good morning. Thanks for joining in. Prashant here. Let me just sort of take this towards
Prashant,
tractors.
Hi, morning.
Hi. Nice to see you, Rajesh, as always. On a year-to-date basis, tractor sales are a little subdued, right? But we are getting into the election season. Typically, what happens ahead of general elections? I mean, there is more money in the system, that is for sure. Should we expect a better outlook over the next, say, 2 quarters or so?
That's Prashant, actually a very interesting question. So 2 things happen around elections. One is, you're right that typically spending in rural does go up, but the election period itself is not a great buying period because very large chunk of people are engaged around election campaigning. So the election months and the lead in into that, normally in those states or whatever is normally a little bit of a slow time, but that catches up later. It's like people are postponing to a time when they have a little more time to go and evaluate and buy products. But of course, this year the tractor industry is slow. We were anticipating that. We had started by saying low single digits. More recently, we are saying it will be flattish for the industry for the year. We have gained market share again about over 1 share point, and we have been showing some growth as a consequence of that. So in November we grew 4.7%. So what is leading to a slowdown? I think it's been a little bit around the monsoon timing. Some of the states in the south haven't really had very good rainfall, but it's also a very high base out of the past year. Last year the tractor industry was a 950,000, which is a very, very large industry size, and we were expecting that on a high base there will be some kind of a tapering off for a year or so.
Hi Rajesh, Nigel on this side. Rajesh, first of all, congratulations to you and team as well with regard to the kind of launches you all have done the last few years. I don't think I've ever got so many requests that can you speak to the management to get our delivery on time, because there's so much of demand for some of the vehicles that you all have launched. But the next phase of growth is going to be the EV space. Tell us about the rollout plans out there. I think you have 4 or 5 launches planned in the next 3 or 4 years. So tell us, when do we see the first EV and how do you expect that to ramp up?
Yeah, so we've really put out, unlike what we do in the past, the whole portfolio of products. The first vehicle or 2 out of that will happen in early 2025. Production would start in 2024, but we would get it to market in early 2025. We're very excited about the way they're coming. They're testing very well. They've run more than 300,000 kilometers already on the tracks cumulatively. Several vehicles running on our tracks, and they're performing very well, and we're benchmarking them with the best in the world. So they would be a very exciting portfolio of products. Of course, many of you have seen the design. They are really, really striking, strong, powerful designs, and but there's much more to it than just the design. So wait and watch that space.
Okay, that's on the EV space. I just wanted one thought from your end on the operational performance. I know you won't want to give me any numbers, But if you look at the margins, right, you map the margins over the last 5 to 6 quarters, you've stayed in that range of around 12 to 13.5%. Now that you're getting into, over the next couple of years, getting into the electric vehicle space, SUVs are doing very well, tractors are coming back. Is there scope for your margin profile to rise above this 12-13% mark?
Yeah, Sonia, so, you know, when we talk about margins, we often kind of guide that when you look at a total margin, it's not really representative because we have two different businesses with different margin profiles. There's an auto business which has gained a lot of margin. It's now, as you saw in the last quarter numbers, we've got to 7.9% for our auto business. The tractor margins are, we say typically, you know, we believe is a good margin in the range of, for our core tractor business, between 17 to 19%. We are in that region. But as the auto portfolio is becoming stronger and growing very fast, the weightage of margin is bound to be affected because auto is, which is growing much faster at the moment, is on a 7.9% margin profile. And when you compare that with farm, which is on a 17% margin profile, obviously the weighted margin is going to come down as auto grows faster than farm. Does that help answer the question? So I think we are basically growing auto margins very well. Farm margins, you know, are flattish given the nature of the industry, but we often say that irrespective of what's happening in the industry, the tractor margins operate within the range of 17 to 19%, which has really been our strength.
All right, Rajesh, we'll leave it there. Thank you so much for joining us here on this special day and speaking with us here. Thank you very much. And thanks for all the support over the years and look forward to more.
Pleasure. And have a great week of celebration, all of you.
Thank you. Will do. Appreciate it. Well, let's move on from one top management to another top management. Dinesh Khara is chairman of the country's largest bank, State Bank of India. Let's get chatting with Mr. Khara about, of course, the implications of, you know, the increase in risk weights that the RBI implemented. Some of what is we are only starting to understand now, like in the case of this sharp fall that we're seeing in Paytm. But first of all, Mr. Khara, great to have you with us here on CNBC. Prashant this side. You know, we're celebrating 25 years here at CNBC, so thank you very much for your support all these years, sir.
Thank you very much, and all the very best to CNBC also.
Thank you so much, sir. So, you know, I just want to begin there, what I said earlier, which is some of this, you know, the risk weight increase trickling through. We spoke with you earlier, we spoke with others as well, and the general understanding is that the smaller ticket size loans, you know, under 50,000 rupee loans on the unsecured side, that is essentially going to see a big slowdown. Is that your understanding as well? And I mean, if you can kind of explain that to us.
Sure, I think there is a lot of anxiety on this particular RBI guidance in terms of RWA. But the way I look at it is that this is actually applicable only to consumer loans in general, but for housing loan, education loan, vehicle loans, and loans secured by gold and jewelry. When you mentioned about, you know, low ticket loan, many of them are the loan against gold and gold jewelry also. So the general belief that, you know, that there'll be a slowdown in the loans and in the low ticket value, it may or may not really happen. So if at all we exclude these, we filter out these exclusions from the consumer credit, we observe that the consumer credit has been growing at about 25% plus since May 22. And the share of these loans, which are actually impacted by RBI norms, is just about 15 trillion on a total loan base of about 151 trillion of the banking system. So in all about, it is about 9.8 to 10% as on September 23. So if we look at the impacted portion of the personal loan category, I don't really expect that it will have a significant impact.
Okay.
The other piece which I may share with you, that the banking system overall are holding about excess capital to the tune of about 7 trillion. And when we evaluated the impact of these higher RWAs, it will consume only about 84,000 crore worth of capital from the banking system. So in all, about 0.70% is the overall consumption of the capital for this particular piece. So I think for all purposes, I perceive it to be a non-event.
Okay, got it. I mean, from a banking, but absolutely. I mean, there's excess capital in the system, and the implication will be small. But as the country's largest banker, sir, you've got a bird's eye view of which segments are accelerating, where perhaps there is trouble fermenting, etc. Specifically for fintechs, what is your view, Mr. Khara? Who were, the business model for many was, of course, built around building out the lending business. Are the concerns and what the RBI has done a bit of a body blow there, or you don't believe so for that segment, for fintechs?
I think agnostic to fintech or otherwise, the way I look at it is that if at all the lending entity have got a system in place for understanding the credit profile of the borrower, and they are mindful of the risk which they are undertaking, I think that is something which is very critical, whether it is small value, low value, high value, whatever it is. But very important is underwriting standards and also the collection mechanisms. What is actually was probably a worrying area was this excessive BNPL which was seen, where simply on looking at a particular transaction, the offers were being made for offering the credit. That is something which is a matter of concern. And I think that particular segment of the business might get affected. But other than that, I perceive that it should not have any significant impact overall.
Hi, Mr. Khara. Good morning, and thanks so much for joining in. Nigel on this side. Well, I wanted to ask you about the other piece of news then. How much of your lending, how much of your loan book is towards NBFCs? If you could give it to us in percentage terms.
NBFC exposure should be, we have got a loan book about 36 trillion, 36 trillion. So on that, it would be somewhere around 8-9%. And it would actually involve some of the public sector sponsored NBFCs like, the AAA rated NBFCs also. Significant portion of that is, of this NBFC book is essentially those NBFCs or the NBFCs which are supported by leading groups, and they are very well managed also.
Okay. Mr. Khara,
small NBFCs composition would be very, very small.
Okay, got it. Mr. Khara, good morning and thank you for being with us on the channel. I just wanted to talk a little bit about growth as well. What kind of loan growth do you see, not just for yourself, but for the industry overall? Which are the pockets that are picking up now, both in terms of corporate as well as retail loans? And, overall, what's your vision for both FY24 and 25?
Well, as far as the loan growth is concerned, we are seeing a lot of interest coming in from the rural and semi-urban space also. So actually, corporate, we do get to see the positive trends as far as the renewable is concerned, and as far as EVs are concerned, and even the conventional steel, cement. So all these areas we are seeing good traction. So I think corporate book also, we expect that this quarter we should get to see much better growth even in the corporate sector also. And the SME space is witnessing a decent growth. And apart from that, I would say that as far as the retail is concerned, that will continue to see the very strong growth, including the home loans and the real estate. Actually, home loans, essentially home loans are seeing decent growth. I would just give you some kind of a comparative. As far as the housing is concerned, for the system as a whole, as compared to about 9%, it has grown very well. From April to October, it is somewhere around 25-26% growth is seen. So I would say that this is a very promising sector, and this also leads to growth in all the core sectors of the economy. The infrastructure is more or less at the same level where it was in the previous year for the system as a whole. But this is the other area which is going to see growth. And I think I would say that rural, SME and corporate also will get to see a reasonably decent growth.
Okay. So when you talk about decent growth, what are the numbers that you're looking at, and also what does this mean in terms of the asset quality for the bank?
Well, as far as we expect that the system should be growing in the range of about 16 to 18%.
Okay, that's for FY24, is it?
That's right. That's it.
Okay, and what are we looking at for industry growth in FY25? Would it be in the 16 to 18% range or better?
I would say that this is a function of how the real economy works, and the early trends which are seen as of now for the year 24-25 are also quite encouraging. So I think with that in mind, my expectation would be that though it is too early to predict what is the likely growth in the year 24-25, but my normal expectation would be that it should be in the similar range.
All right, Mr. Khara, we'll leave it at that. Thank you so much for joining us. Appreciate your time here on CNBC TV18. Let's slip into a quick break on that note. On the other side of the break, Mitesh will be joining us for a technical check on the markets. Very quiet, really, the start of the market today, just consolidating around that 20,500 mark. But more on the markets in a bit. Stay tuned.
I would like to congratulate the entire CNBC TV18 team for completing 25 years in the Indian news industry. It has been the channel of the business channel of the choice.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Well, the market's a little bit under pressure. The good news, though, is you still have more number of stocks that are advancing in comparison to the number of stocks that are declining. So the crisscross line should come up for you on the screen. Mitesh Thakkar is back with us. Well, Mitesh, what do you make of this morning's trading session? After a while, in the first half, we're down closer around 70 points. Would you be looking to buy into this dip? And particularly on the Nifty Bank, from around that 47,000 mark, we've come down to around 46,500. Where does support come in at?
Morning again, Nigel. I think while the Nifty, has come off a bit, but I think it is the Bank Nifty which has come into the buying zone for me. 46,500 was my support area, and I think the low which we've got today is around those levels, 46,507. So we have bought some quantity, not a very aggressive one. I think once we see a reversal on the hourly charts, we'll add more to long positions. But yeah, I think around 46,500 buy with a 300 point kind of a stop at 46,200. I do believe that there's a good chance of us not only retesting the recent highs of 47,250, but also, getting past that. So in that sense, maintaining a long bias and using this decline to buy into it, keep a stop below 16,200. 46,200. And on the stock side, I have a buy on MRF with a stop at 1,15,000 for targets of around 1,22,000. And the other one which I like is Glenmark Pharma. That's a buy with a stop at 808 for targets of 840.
Okay, thanks a lot for that. Well, power is one space that is coming back in a big way, so don't lose sight of that. Tata Power is now up almost 5%. NHPC is up almost about 3% This whole power and renewable energy space has come back in a big way over the last many days. So the market has taken note of that. But let's shift focus to the commodity space. One big positive trigger for this market is the fall that we've seen in Brent crude prices. And Manisha Gupta has been, praising us of that. Manisha, morning. What are you tracking today?
Sonia, thank you for that. Well, this week, every day, we have seen a decline come in for the crude oil prices. So we are trading below 75 for the Brent prices. We're also trading below 70 for the WTI prices there. And it's a 5-month lows that you are looking at in sense of crude oil prices. So with nearly 4% of a decline coming in for the crude prices, this hasn't been such a great week. And not just crude, this is what the other commodities also have done. So while the crude is trading at a 5-month lows, you have natural gas at a 13-week lows, heating oil 4-month lows, and the gasoline prices are the most hit, trading at a 1-year lows in the international international markets. This is what we've done in sense of the previous week in case of prices there. So while the week has seen 8% of decline come in for the crude oil prices, natural gas is down by 8.5%. It's a 6% decline coming in for heating oil and gasoline. The only thing, as I've been telling you, the positive trade has been in case of coal, where we've seen 9% of gains. Nearly $140 a ton is how coal prices are trading right now. But for the crude oil prices, there are various concerns right now. To begin with, while we've seen the US inventories for crude gain up, the gasoline inventories have jumped up by 5.4 million barrels. So that tells you that the demand seems to be slowing down in US as well. And not just US, you are looking at concerns that the OPEC and allies, while they have talked about a 2.2 million barrels per day of a cut, but remember that is voluntary, and markets do believe that you may not see that happen on ground. On paper itself is much on the lower side there. And then apart from that, it also is about the Chinese demand, which has been on the weaker side. From Moody's giving an outlook in sense of negative, the kind of imports that we saw in China in major part of this year tells you that China is sitting on huge inventories, and if the demand does not pick up, then China may not want to import so much going forward. So that's one another market which may not be looking at so much demand coming in. The dollar index trading at a 2-week highs has been putting pressure as well. And then you have the PMI data that came in from Japan, US, Eurozone. All of that came in on the weaker side for the month of November, and that has been weighing onto the markets. It also has been about Saudi Arabia for the first time in 7 months cutting the prices, official prices that is, for the month of January, saying that the demand seems to be easing and the premium is coming off. And that tells you that those 95, 96 kind of levels that we saw in the month of September perhaps are not coming in a jiffy. The street is expecting that there could be a surplus in this quarter and the next as well, and the demand hasn't picked up yet. It's all going to be about the US non-farm payroll data tomorrow. All eyes on that for further direction.
All right, Manisha, thanks a lot for that. Let's sip into a quick break. On the other side, we'll get you an exclusive conversation with R. Shankar Raman, the whole-time Director and Chief Financial Officer at Larsen & Toubro. Stay with us.
Congratulations on your anniversary. I've been talking to the channel for 20 years, so it's my pleasure to be.
Co-powered by CNBC TV18, embarking on a quarter century of excellence.
Welcome back. To reiterate, we are stepping into our Silver Jubilee year, our 25th year, and we wanted to have the best of India Inc. with us. So joining me now is the Group CFO and Board Member at Larsen & Toubro, Mr. R. Shankar Raman. Mr. Shankar Raman, thank you very much indeed for joining us on our big day. We would like to think that we are lucky because the global and the Indian news is also brimming with positivity. Let me start with the GDP number, which surprised hugely on the positive. It's not just the 7.6% GDP number. It was largely because manufacturing was 13.9% and construction, something that you would be interested in, has grown at 13.3%. So let me start there. You gave us a very good guidance in terms of your revenue growth. Do you think it is going to be even better than that, given this macro performance?
Thank you, Lata, for having me. And let me start by wishing CNBC TV18 and all of you my heartiest congratulations. Entering into the 25th year is a big milestone, and I think sustainability, staying relevant, etc., has contributed. So credit to all of you who are part of that brand to have made the brand so enduring and dear to the viewers. So congratulations.
Thank you.
Now coming back to the question that you asked, I think it is no surprise that the construction contribution is picking up, because if you look at the orders that have got placed out over the last 2 years, ever since the government adopted the policy to be investment-led in terms of creating employment, making sure consumption demand revives on the back of that employment generation. It was but natural that with the lag of 1-2 years, construction will begin to pick up. Most of the projects that were awarded post-COVID are all in advanced stages of construction. And consequently, it is not surprising that their growth contribution is significant. We fortunately are in the thick of many of these important projects. And one of the reasons why during the discussions that we had post our half-yearly results, was that we stuck our neck out and said that we are very likely to outperform our revenue projections that were put out as guidance at the beginning of the year. We had guided somewhere between 12 and 15%. Yes. And looking at the pace at which things were moving, we were reasonably confident that we could possibly exceed that guidance. By what order of magnitude could depend on so many other factors, because today, as we construct more and more, still clearances and approvals are part and parcel of that construction journey. Not everything is available to companies upfront for us to predict as to what kind of resources it has to deploy and how the revenues will map out. Now, for example, the poll in 4 states or 5 states actually put a temporary halt on some of the work that we were doing in those states. Now, we are also heading towards the national elections. So consequently, some interruptions are to be anticipated, which is what is making the whole job of predicting the exact percentage of growth over and above our guidance becomes tricky. Okay. We do believe that the year could go past because our assessment is the elections could be mostly in maybe April. Yeah. Around the time when schools shut and that infrastructure is available as polling booths, etc., could be the ideal time, but one never knows. So consequently, depends on whether we have the entire 12 month or we have a portion of that chopped off would determine the growth. But the momentum is robust. Okay. And I'm glad to tell you that the authorities, be it local authorities or central authorities, and the multilateral funding agencies are taking enormous interest to ensure that the cost of infrastructure that we are building stays competitive by arresting the time overrun. I think it's good that the system has recognized the cost overrun as a consequence of time overrun. So if you want to get the cost under control, we'll have to get the time under control. And that is also helping the industry's costs.
Yes, yes, we saw your working capital to sales also move into a very healthy direction. Should you see more of that, since you say that everyone is now conscious of time overruns, more improvements in working capital to sales?
There is a natural cycle to the invoicing and collections. And given the fact that many of the projects are state or central government sponsored projects, there is a lead lag in collecting this money. My sense is that if we are able to operate working capital at about 16 to 18% band of the revenues, I think we are doing a commendable job. There is always a possibility to keep improving, because never say never for any such improvements. But it does look more practical to assume and operate at a 16-17% band rather than look at a 7-8% band.
Okay, fair enough. Let me come to the order book. I mean, you were always expected to better than that 10 to 12%. I mean, by a huge margin. But now you've lately announced a lot of big orders from the Middle, even more big orders from the Middle East. So you don't want to increase that order book guidance? Or even if you can tell me this, do you feel that you will, outperform by an even larger margin than you thought perhaps a couple of months back?
I know when we last spoke end October,
yes,
we did mention that we will outperform the guidance. If you really see, the first 2 months have been relatively quiet of the current quarter as compared to the past 2 months leading up to the end of the previous quarter. There is a certain volatility and fluctuations to this ordering momentum because of the processes involved. It is good that the order inflow is helped by some large orders from Middle East. But if you look at the pipeline of orders that are lined up, I think there is still some more distance to go before we can announce, complete outperformance to the order of magnitude that you possibly are hinting. We will have an opportunity every 90 days to revisit this. So end of this month, as we gather ourselves to see how the last quarter of the year looks, we will have an opportunity to see whether we can be a little more precise than what we are. But I do expect a certain slowdown in the last quarter. Run up to elections have always been indicative of that, because any orders that you give out now invariably the execution will be carried under the supervision of the next government.
Yes.
Now, how far will the government's, the current incumbent government will sort of commit themselves to these programs is to be seen, because we've had history of some of the state governments cancelling projects that have been announced by the earlier governments for no rhyme or reason.
Yeah.
And I think it has put a lot of construction industry into a big spin because of the resources that it had committed, etc. So even in the industry, we will possibly be a little cagey and slow of the orders that we win in Q4 before we really go full clip. So I think there is a certain natural headwind that will develop. So I think we'll have to factor for that as well.
I wanted, if you can update us on, the vertical of electrolyzers and green hydrogen. That was the other thing Mr. Subramanian was very excited about. So any update on that and its future in the next 2 years?
Yeah, I think we realize the fact that energy transition is going to be a big play globally, and India cannot be left behind. And consequently, when we looked at the various opportunities for this transition, two things stood out. One is India needs to get more solar generation while waiting for solution for battery storage, etc. The solar generation needs to be augmented. So we started betting on solar projects. Fortunately for us, international orders also came our way. And since today we are fairly large with almost $6 billion worth of order backlog just in solar EPC projects. Secondly, we also looked at hydrogen as an emerging fuel source for industrial application at least, because we yet do not know the cost competitiveness and the safety factors around its use for individual consumption. But at industrial application, automotive transportation purposes, it did look promising. So we said that we will get into that play by manufacturing electrolyzer, which is a key component for hydrogen generation. Fortunately for us, I think we scouted around and got a technology tie-up with Nifty Energy of France. Today, as we speak, the first electrolyzer is under construction. We are putting that together in our Atara plant. By end of this fiscal, we'll possibly have a prototype, and we could check that for its application, its features, its cost competitiveness, global attractiveness, etc. And if the product marks all this well, we'll possibly experiment it with a couple of hydrogen EPC projects, by which time we hope to get. And then if that does well, we will possibly take it as a global product. So there is an opportunity to scale this electrolyzer manufacturing activity. And we think, being the manufacturing experts that we are in some of these areas, we think we stand a good chance.
Okay.
The other area that actually excited us is putting together as a EPC package for hydrogen manufacturing. Fortunately for us, we struck a transaction with IOCL at an MOU basis. IOCL as well as Renew Power will provide the green power for the electrolyzer manufacturing. We would put up a plant which will generate hydrogen, which will be used for the refinery of IOCL. Depending on how this goes, this can be replicated in the other refineries of IOCL, as well as replicated in other refineries beyond IOCL. So this being, and this is more public sector led at the moment, but I'm sure the private sector, who consume a lot of industrial fuel, would also look at this, provided the solution is cost effective and functionalities meet their requirements. So we are pretty excited about application of this hydrogen through our EPC and electrolyzer manufacturing. Added to this excitement is our recent foray into semiconductors, because that's another area that we have been trying to explore as to what is it that we could do. We realized that our ability to compete with global giants on manufacturing fabs is going to be very limited. So consequently, we shifted our attention to design. And now we have put together a company, and we're in the process of assembling a team which will work on design, 40 nanometers and beyond in terms of the chips. And we will possibly co-create a design along with manufacturers, OEM. And hopefully, if the functionality tests are passed, we would design those chips using the talent pool that India is blessed with on chip designing.
Okay, now that's all the cutting edge areas that one would want the company to be in. Very good to hear. It's not surprising, therefore, that the L&T stock is at all-time highs. You're celebrating along with us. Thank you very much, Mr. Shankar Raman, for this conversation.
Thank you. Hopes precede actual performance. We hope we back it up with performance. Thank you.
Thank you, sir.
All
Thank you
the
very
very
much. Thank you very much for that. Have to take a quick break, and thereafter it'll be time for Chartbusters.
I wish all the best for the CNBC 18 birthday on 7th December. It will be a very, I wish that it will be a very successful, grand success.